Hey guys, I'm here with the fifth and final series episode on taxable accounts. As always, this is not personal, financial, tax, or investment advice. It's just for education. So we've been through a lot. We've covered a lot of material, and now I'm kind of sequentially and chronologically thinking through this. So naturally, the last installment here is going to be about estate planning, charitable giving, and legacy planning. So let's just kind of take these one at a time. So where does a taxable account play into your overall estate plan? There's a couple of things you need to know here. First, you need to know how this account is treated at death of the owner. So if you were to leave your taxable account to someone else, whether that's a spouse or a child or another heir, basically they're going to receive what's called a basis step up at death. So that basically just means, say you bought a stock, I'm going to make this simple, for $100,000. It goes to $1 million, and the day that you died, it's worth $1 million. Normally, if that was not given at death, meaning through a will or passed on, there would be $900,000 of capital gains in that account. Now, the benefit is, if this is, again, given at death, whoever receives that account actually doesn't have the $900,000 of capital gains. That's really, really powerful. Now, the other thing that can be really helpful here is if you want to give to charity, whether that's while you're still alive or after you're gone, there is a great opportunity here in a taxable account, especially if you own some individual stocks, because you can actually give more strategically and more beneficially to the charities of your choice inside something like a taxable account. And that's simply because when you give appreciated stock, again, another example, if we bought a stock at 100,000 and it went up to 500,000, you can essentially avoid paying personally those capital gains by gifting the stock directly to a charity. Now, sometimes that's difficult, so you have to open what's called a donor advised fund. And there are limits here, just to be clear, in terms of what you can give as a percentage of your AGI and actually deduct it on your taxes. But I just want you to know that that's a powerful strategy for gifting. And that doesn't have to be a one-time gift. That could be something you do every year, for example, in retirement. Another thing that can be helpful is this is a perfect type of account to actually put in trust. So most commonly, people are going to have a revocable living trust. And when you do that, that account's going to avoid probate altogether when you're gone. And also, if you're someone who wants to do another charitable type trust, like a charitable remainder trust, that can also be really beneficial from a tax perspective. So there's a lot of flexibility and a lot of reasons why this account is really great for estate, gifting, and legacy. Hope this series was helpful, and I'll see you guys on the next one.